Okay, wrapping up chapter 5, inventory costing methods. There's some bits and pieces in this lecture. Probably just going to go through the effects of the financial statements, talk about the lower of cost or market, and then maybe finish up with some errors in financial statements and how those look and how they carry through the financial statements from one year to the next. Okay, so first in, last in, or weighted average, or I should be first in, first out, last in, first out, weighted average. So if you think about first in, first out, what we're saying is the very first thing that comes in is going to go out. Ugh, okay. But what we are also saying is that our ending inventory are the last things that we purchased. So the first in, first out method is going to state ending inventory in today's value. Whereas last in, first out, obviously, the last thing that came in is the first thing that we assigned to cost of goods sold. And therefore, the cost of goods sold is more reflective of current costs. And the ending balance will have older costs in it. And then the weighted average method kind of smooths those out. The next slide I think is pretty important. Okay, if we were to go through various examples and we would use the specific method, or we would use FIFO, LIFO, or weighted average, what we're saying is, hey, listen, depending on the costing method that we're gonna use, we're gonna get different cost of goods sold, right? So if prices are fluctuating throughout the period while we are acquiring inventory, and then we're selling that inventory based on one of the four methods, obviously the costs that we assign to goods that we're selling are going to be different under the four methods. So just as an example, this slide is essentially saying, hey, listen, we have the same revenue, that's not going to change, and the costs associated with the goods and services that we are selling are going to change, and therefore our profit's going to be different, and then our ending inventory is going to be different. Financial statements will look much different. Which one's better, which one's worse? That's way beyond the scope of this class, but if I was looking to reduce my tax liability, maybe in this particular example, I'd want to go with the LIFO because that's going to give me the lowest profit, and our taxes are based on our profit. If I was, on the other hand, a public company and I wanted to show higher profits so that I can encourage more investors to invest in my business, maybe all else equal, I would be inclined to use FIFO. At the end of the day, in the long run, it doesn't really matter which one we're using because everything's going to get worked out, right? At some point, even if we are using last in, first out, right? Those first units we produced, purchased, at some point, those are going to make their way out of inventory. So there's a lot we can continue on this conversation, right? Do you want to use last in, first out, or first in, first out when you're dealing with high tech companies, right? So if products, the cost of inputs is dramatically going down, what financial method should we use? I would think we would want to avoid a situation where we have last in, first out, right? So if I have last in, first out, my inventory at the end of the period are going to be the first things that came in. And if things continuously get less expensive as we gain efficiencies in manufacturing, then my inventory is going to be overstated because the current cost, right, is much less than what my inventory is showing. Again, those are really interesting concepts, but at the end of the day, there aren't too many homework questions predicated on these portions or concepts. Okay, compute the lower of cost or market amount of inventory. I have a feeling this slide's going to be super complicated. Okay, maybe it's not. Lower of cost or market, inventory must be reported at market value when market is lower than cost. So market, we're saying, hey, listen, if I have a bunch of lumber and my warehouse burns to the ground and I want to replace the lumber that I had in inventory, what we're saying is the market cost is the replacement cost. How much would it cost me to purchase more lumber for my inventory? Okay. And what we're saying with the lower of cost or market is if I have my inventory account and my inventory account says we are looking at $400,000 according to our books and records. And it's all the lumber that we have that we sell to the community of builders in our area. If, for instance, this lumber hypothetically would burn down and we had to go back out into the market and acquire to replace all of the inventory as it existed before the fire, and if the inventory was 350,000, if this is market and this is our cost or what's in our financial statements, the lower of cost or market would say our financial statements currently say 400,000, but they should say 350,000 because 350,000 is the lower of the two options. Maybe I can go back to the slides. If I have to make an adjustment, right? That is what we are doing in this slide. We're going to plug the difference to cost of goods sold and we would lower our merchandise inventory. In my example, we would do cost of goods sold 50,000 and inventory 50,000, right? That's the difference between the two. And if I make this adjusting entry, I would lower the cost of my inventory to 350. That is the lower of cost or market. Okay. How about the effects of inventory errors? This is kind of an interesting concept. And I'll go through it briefly and then we will call it a day on this video. Okay, so here I have an income statement. And the income statement is breaking out the inventory account, right? If I think about the inventory account, it's a T account, just like all the others. We have a beginning balance, and then we have purchases, and that will give us everything we have available to sell. Then we will have cost of goods sold, right? The difference between everything we have available to us, cost of goods sold, will be our ending inventory. And so what we're saying here is if there is an error in ending inventory, right? If our ending inventory is 16,000, but it should be, I don't know, 12,000, right? This is overstated by $4,000. And we don't calculate ending inventory based on beginning balance plus purchases gives us everything available. Then we subtract cost of goods sold. That's actually not how we calculate ending inventory. The way that we calculate ending inventory is we physically go to the inventory space and count up and add up all of the cost of inventory. So what we actually do is we start with beginning balance. We then add all the purchases to derive everything we have available for us. And then we will count the inventory and we will subtract ending inventory from what we have available to back into cost of goods sold. Okay? So if for whatever reason we miscount or we don't do this and we mistakenly say our ending inventory is 16,000 when it should be 12,000, then we are understating our cost of goods sold, right? Our cost of goods sold says 64,000 based on 16,000 in ending inventory. If the 16,000 was less, I would be subtracting away less from what I have available, and therefore cost of goods would be higher. And then not only is this year's financial statements incorrect, but next year they're also incorrect. And they're incorrect because the ending value of 16,000 is the beginning value of our next year. And so I would go through the whole process again. I would have my inventory account, and now my beginning balance is messed up. Then I would add purchases that would give me everything I had available to me. Then I'm going to subtract out my ending inventory to back into cost of goods sold. Not God, cost of goods sold. Then this would be incorrect. But as long as my ending inventory, the count, was correct, then this year's financial statements would be okay because we're starting with a correct number in year 3. Interesting concept. That is an interesting concept, and there may be homework questions available to that. Okay. And if there are, we're going to go through those together. But that is chapter 5.